All right, everyone. Thanks very much for joining today's webinar. We're going to get started at 12:02, so in just less than a minute, basically. So this will let some other folks come in and get settled. And in the meantime, if you need to run to the bathroom, grab a cup of coffee, grab a bite to eat, whatever you need to do, go do that now and get back here so we can jump into today's presentation.
Matt, any plans for the rainy Memorial Day weekend?
I work remotely from Northern California, so it will not
Uh,
be rainy for me. It'll be beautiful weather, and I will be in Napa, California at the Bottle Rock Festival.
oh, sounds like fun.
Yeah.
I will be at the rainy Jersey Shore.
All right. Well, that sounds like it will be its own adventure.
Sure, sure. Always good to get to a different area, zip code to get
Exactly.
away.
Exactly. It is 12:02, so we'll get started. Today's presentation is the car wash industry the right alternative investment for you? We're being joined today by Bob Paulus of PPR Capital Management. We have the mandatory disclosure, which is that this presentation is meant for educational purposes only. Camaplan does not provide any investment or tax advice. We encourage you to do your own due diligence and seek the guidance from the appropriate professionals before making any investment or tax decisions. Um, Housekeeping topic: chat will be turned off during the presentation, but please use the Q&A function to ask your questions or make comments. Whatever you want to do, just let's keep this a nice open dialogue. It's much better as a conversation than just hearing a monologue. So please use your Q&A function in Zoom to ask your questions. Finally, if you have any questions about self-direction or something doesn't get answered today, or you just want to say hello and get to know Camaplan a little bit more, you can reach me at mmore@camaplan.com, or you can reach me at my direct line there, or you can always schedule a call directly with me. So without further ado, I'll pass things over to you, Bob.
Thanks, Matt. This is my second Camo webinar, so again, go easy on me, but getting less nervous. I would like to thank you and Kama for helping alternative investment companies like myself connect with investors.
We're
So
happy to
let
have you and appreciate the role that you play in giving people more options beyond what they're getting in the stock market.
Good, good, good. So the purpose today is to educate people about the car wash industry, as well as the importance of diversifying risk. I plan to be just right around 20 minutes. And if you're interested in learning more about a PPR investment, Matt's going to share the contact information. And a couple options are schedule a one-on-one call with me, or if you want a free lunch, I'm happy to go out with you, and you can even invite some friends if you'd like. So before I go into the car wash, I'd like to give you a brief introduction to PPR. I co-founded the company in 2007, along with my partners, Dave Van Horn and John Sweeney. And we've now grown to about 40 employees. And we're located in Wayne, PA, about a few minutes up the road from King of Prussia Mall. And in the beginning in '07, we started by buying second mortgages at 3 or 4 cents on the dollar for $40,000 UPB, unpaid principal balance mortgages. So paying about 12 to 1500 bucks. Pretty good deal back then. Then in 2013, as we had more experience, we're raising more capital. We got into first liens because we couldn't deploy enough in those cheap seconds. Then in 19, we started buying multifamily and build to rent properties. There was a wonderful call in January. If people can access that, I gave a lot more detail. Our current fund pays 9% current. We pay monthly, or 11% deferred if you want to take a lump sum at the end of the 3-year term. And it's a $50,000 minimum. So what is that secured by? It's secured by real estate in all 50 states. We have about 3,600 non-performing first liens in hundreds of different markets and a little over 3,000 doors in the multifamily and build to rent. I'm gonna give you a little scope. It's a little over 600 million of equity under management and about 1.5 billion in assets. So it kind of gives you a little scope for the size of the company. Uh, so let's go to what do the financial advisors say? Everyone's concerned with their portfolio and their traditional things that my parents heard and I heard when I was a much younger man is do an 80-20 split. You want 80% of your money in stocks and 20% in bonds to have a little bit of stability. And as you get older, your late 50s, like I am now, you want to start to take some risk off the table and you want to have maybe 60% in stocks and 40% in the bond markets. So the problem there is in the 50s, as people work longer and longer, you want to push out the having your portfolio grow aggressively as long as you can. And I would say in the last 5 to 10 years, many financial advisors are suggesting a 50-30-20 split. So what does that mean? A 50% in stocks, 30% in bonds, and 20% in alternative investments. And the reason for that are alternative investments are designed to provide a strong return that has a low correlation to the stock and bond market. And that's why the PPR fund that I mentioned a minute or two ago, there's a very, very low correlation between the market and residential real estate. Uh, so, with that said, let's talk about the car wash industry.
Well, so this is always something that I'm interested to learn more about. Um, you had the mortgage note strategy, and you still have it. You're still doing
Mhm.
that. And then now you have the car wash strategy as well. Can you provide a little bit of context about why PPR decided to go in that direction?
Sure. So, as we start to grow from the NPL space, it's critical to diversify. If you don't diversify, you die. Ask Radio Shack, ask Kodak. So, we got into the multifamily, then we got into the build to rent, and we wanted to continue to diversify for the protection of the investors. And one of the things we looked at was self-storage. But the downside as we researched that is data shows when you do have a recession, we're going to have one, whether it's in the next year or the next 20 years, eventually it's historical, that the people view that as something they can do without. And historically in the car wash industry, next to a person's house, their car is their greatest asset and they tend to want to take care of that asset. So we feel that it's not going to be affected the same way. And again, we obviously we wanted to stay within the real estate business, and this was a nice hedge because we do own all of the land for all of the locations. So let me educate you, give you a little information on the car wash industry. It's about a $14 billion industry that's projected to grow about 4 to 5% annually through 2031. So Matt, let me ask you a question. How many car washes are there in this country? Can you give me a head count? What's your
Um,
guesstimate?
4,500.
4,500 in the country? My good Lord. Uh, about 75,000.
Oh,
Over
okay. All right. Yeah.
75,000.
I guess I should have said 45,000. That was a terrible guess. I'm in
That's okay.
California. There's probably 4,500 in
I think
Sacramento alone.
I think you were guessing maybe 4,500 in Pennsylvania. But
Yeah,
anyway,
exactly.
so over 75,000 car washes, but it's incredibly fragmented. Probably 70% are mom and pops that only own 1 to 5 locations. And that makes it impossible to get a good economy of scale to get increased multiples. And in fact, the top 4 or 5 operators own less than 2% of the industry. Now, Matt, I don't want you to spend your weekend wondering who are the top in the industry. So I'm going to share it with you.
Thank you.
So the biggest one, it's called Mister, and they have a little over 425 locations and they trade on the New York Stock Exchange. Then you have Take Five, close to 400, Zips, close to 300, and Club Express and Quick Quack are right around 200 locations. And Tommy's is about 250, so they're right in that mix. But let's talk about what are the different types of car washes. Number one, you have the self-service bay where you pull in, you get out of the car, and you actually take the hose off the wall. It has soap in there and water, and you're washing the car yourself. Next, you have the in-bay automatic where you pull in, you put the car in park, and you listen to the radio for a couple minutes as the machine revolves around you and it cleans your car. And depending on what level you select, it might wax it, do your wheels, etc. Next is the belt and pulley, which is one of the more popular ones along with the conveyor. So the belt and pulley, you pull up and the wheel attaches to the belt and it pulls you through the car wash. Very similar is the conveyor system. The conveyor, probably the best way to describe that if you've never seen it is it's like a moving sidewalk for your car. And then last, you have the high-end luxury where you might have six people hand wash your car and then charge you $100, which isn't too popular. So what are the pluses and minuses of each? Well, if you want to own your own business, the self-service and the in-bay automatic are very inexpensive to get off the ground. You're basically buying a shell of a building and the equipment is pretty cheap to get started. But you're not able to charge a lot, especially for the self-service bay. You picture you're basically feeding quarters or dollar bills in there, a couple bucks to get started. So it's from an operator standpoint, it's tough to make a lot of money with those couple. With the belt and pulley system, now you're starting to talk to you're getting up, you're charging maybe $8 or $9 for the low end, 15, $16 for the bells and whistles if you want it waxed and get the wheels cleaned. Uh, but there are some downsides with the belt and pulley. You can't send a light truck through, you can't send a Corvette through because it has wheel restrictions. And another downside is you have probably about a 10-year lifespan on the equipment, whereas the conveyor system has about a 20-year lifespan. And it's quicker. You can get through about 200 cars an hour in the busy times and busy seasons. The 20-year lifspan and it's very automated. So those are some of the pluses and minuses. And if you're, a stat guy, some of the other facts are in the mid 90s, probably over 50% of the people wash the car in their driveway. I know I've been known to do that from time to time on a sunny day. And by 2026, people put more value on their time, but it's still about roughly 20% of the people still wash the car. So there's still room for growth in the industry. So also disclaimer, I'm getting a lot of this information from Pulse Car Wash Market Intelligence affiliated with the International Car Wash Association, so third party. Uh, so let's talk about what direction is the industry going? How are they growing? Well, the subscription model is the direction most companies are going. It's one of the few good things that came out of COVID as everybody was looking for contactless ways to do business. So with the subscription model, the premise is you're paying 1.5 times the cost of a single wash, but now you have unlimited washes. And most of these high-end places, they have sophisticated license plate reader and vehicle recognition software. So you pull up, it's three gates. Two of them are for the monthly subscriptions, reads the license plate, lets them in very quick, no wait. And the third gate is you have a cashier that's trying to sell those subscriptions. So the target is to have 60% of the revenue to be recurring, which is great. It's the first of the month. You have a nice income number coming in, makes it easy to budget. Uh, And it's crazy that despite the fact that people have unlimited car washes, Matt, what's the average you think people go through a year?
Oh, car washes. I'll just speak from my own
The,
experience.
the
I
people,
probably,
if you had an unlimited
oh, I,
subscription,
I, I'm a busy guy, and I've had a car wash subscription, and I thought it was a great thing. Um, I was going once a month though, I think.
Matt, it should make you feel better that you are average.
All
It's
right,
the average
I'm
person
average. Okay,
only goes through 13 times a year.
okay.
And it boggles my mind on the one hand, but I can understand it. I look at Planet Fitness. I probably go 100 times a year. At least that's what I tell people. Where my wife goes twice, but she won't let me cancel a subscription. And 92% of customers surveyed say that they plan to renew the subscriptions at the end of the year. And it's become so popular that number one and two, not surprisingly, are streaming television, recurring plans, and music, such as Spotify. And next are gyms, but the car wash market is shooting up that list pretty quickly as far as number of people that subscribe. Does
Is
that make
there,
sense?
yeah, that makes sense. I can see how obviously having a subscription ensures, regular revenue. Is there any data that you have that shows the impact on um, the automation for letting people in with a license plate reader, so that you're not having to have people who are staffing that, so basically you don't have as many employees working, and it can just be automated through gates and things like that.
Yeah, you really only need two or three people per shift. You obviously know your busy times, what you think, hey, everybody gets in the northern part of the country, snowy times are the best. But what about the summer times? Or what about the place that get no snow? So there it's
Mm,
pollen season.
yep.
Those are some of the busier times a year. So you have a person that is the cashier. You have a person on the inside making sure things are, the people are entering properly. And then depending on the busy times, you might have a third person that's a floater, a troubleshooter, et cetera. Uh, so let's say you want to open your own car wash. What are some things that you want to look at? So you want to look at traffic count, population, median income, three things that make sense, right? So for traffic count, what Tommy's looks for is 20,000 cars per day, but it's got to be on a street that's no more than 45-mile-an-hour speed limit. You don't want to be on a highway where people don't have time to get off. 30,000 in population within 3 miles, and a median income of 50,000 or more. Now, the smart companies, they also want to search out spots near high traffic stores. So like the greatest is either in a shopping center or next to a shopping center that has Starbucks, Chick-fil-A, Dunkin' Donuts, Walmart. There are thousands of people that go into each of those stores every day, and they're out and about, and it's very easy for them to just pull in and get their car washed since they're out. You don't necessarily need to be a destination stop. Uh, so we talked about the automation, and then there are other add-ons, free add-ons. After you pull through the end and the blower dries your car, you're welcome to pull around to the side and not only use a free self vacuum, but they also have a free car mat washer and dryer for the customers to use it if they want to. I guess some other things are there's got to be some people on this call. I know I get the emails a lot from companies that are raising money to buy car washes, and their goal is they're a little ahead of the curve. They get the mom and pop and the multiple, and you want to aggregate up. But some of the downfalls there is they're raising the money and they're buying existing car washes and rebranding them. And some of the money they raise is for acquisition, and some of it is to remodel them, put some paint on, fix some of the structures. But what hurts them is there's still different layouts, different formats, different systems. The The age of the equipment is closer and closer to the end of the lifespan. All of those things are going to hurt the sale value. Just some things to consider if you're getting involved with car wash industry. So I've mentioned Tommy's 3 or 4 times. So let me give you a little more history of Tommy's Express. Uh, they started in 1969 as a family-owned business and now have over 250 locations. And they started franchising in 2016. And by the way, no Tommy's that has met those metrics that I talked earlier, the traffic count, the population, the income, none of those have ever gone out of business. So we, PPR, we are capital raise folks. We are not car wash operators. We have a JV partnership with a company called Olympus Pines, and they run the day-to-day business. They're a company of about 20 people. They were founded in 2020, and they've raised over 100 million in capital. And they're currently running, I think it's 31 Tommy's locations, not including the 7 that we have in our fund that I'm going to talk about later. And a little added bonus is the owner of Tommy's is actually an equity partner in Olympus Pines. So that gives them unparalleled access to new markets. Some of the advantages, in addition to the automated software, the license plate readers, et cetera. It's identical template of 100-foot tunnels, gives them great brand recognition. All similar equipment, counting processes, the conveyor belt model removes wheel restrictions, 20-year lifespan, up to 200 cars per hour. All of that adds a great deal of value. Uh, so I'm here to discuss an opportunity to be part of a Wall Street sized deal, even though you most likely have less capital than the big Wall Street firm. There are 4 or 5 car wash chains that have sold for multiple 14 to 24 multiples, excess of $100 million selling prices in the last 3 years. I'm talking big capital such as KKR, Warburg Pincus, and Iconic. Not sure if you've heard of any of those, but they're pretty well-known big equity firm companies, and they've all paid those multiples. And to give you a little more about this deal structure, this is a $35 million fund with 7 locations. It's a $150,000 minimum, and we're available to qualified people with a $5 million net worth that you self-attest to. And it pays 10% quarterly accrued pref as cash is available. And the upside to investors is about an 18% return. So 10% quarterly as cash is available, and then at sale, another 8% is the forecast. And it's projected to be a 5 or 6 year hold, which generally, once you get everything built, you're looking at 3 years to stabilize it, and then you can start to market to buyers if the market conditions are favorable. We have one location in Chambersburg, PA, that opened in 2023, but we actually acquired it in December of 25, about 6 months ago. We have 2 locations that opened in 2024, one in San Antonio and one in Charleston. And 3 will open by the end of 26 in Lincoln, Nebraska, Mount Laurel, New Jersey, and Lexington, South Carolina. And one of them might slide into, first quarter next year. And then the last one in Fairfax, Virginia, is slated to open in March of 27. So we talked about the mom and pops. The average Tommy's location generates about 2.2 million in revenue, one stabilized, with about 45% margins. And the average metrics for our sites are superior to the Tommy's demographics and metrics. So we think that it's going to be significantly better. So the goal is to aggregate up to about 60 open sites with a development pipeline of another 30 or so. And that that size numbers, that's what's going to generate private equity and accelerate the multiples. Uh, so again, remember I said Tommy's already has 31. We have 7, so we're well on the way to that.
Can I
And
ask you a quick question?
sure.
Um, you're mentioning how these are going to be opening. So earlier you said there's um, some car wash buyers who are buying existing mom and pop shops and they're
Hmm.
basically like rehabbing them.
Hmm.
My understanding then is that you're building these all fresh, and because of the long tube, they have a distinct shape and everything. So these are all constructed new and starting under your ownership.
Correct.
Okay.
The land acquisition is anywhere from, I think, 2 million in Lincoln to 4 million in Fairfax. So call it an average of 3 million to acquire the land. So there's value and collateral there. That's all been taken care. It's all been purchased. Uh, and then about 5 million to build. So the average cost is about 8 million, and we're financing about 60 to 65% of that and raising the rest. And again, the goal there is you have all brand new, all similar looking structures, similar functioning structures, streamlined, easy for private equity to get their mind around that. Does that make sense, Matt?
It does, and that was specifically the question I wanted to ask in reference to what you said about aging equipment and things like that. I guess the benefit, like the benefit of buying something that's already exists is that you could potentially have it stabilize sooner, but
Yep.
the
And it's
benefit
probably
to
cheaper to acquire because you're acquiring one at a time or two or three at a time from the mom and pops. Yep.
whereas there's risk in doing ground up construction, it's costlier, but there's basically a template in terms of location type of what you want and the demographics and all of that, but there's also a template of what you build. And when you go to sell to private equity, you know the actual condition of the equipment of the building and all this stuff, and you can say it
Yep.
factually, whereas the other guys might have a harder time doing that.
Yeah, but it's a little more than that too. It's the fact that everything, all the processes are same, everything is brand new and similar, just makes it more valuable as opposed to having 10 locations that you acquired from 10 separate people
Right.
and they all function differently. You
Yep.
get more of an economy of scale if you have
Okay.
a large number.
Got it.
So what I'd like to do is talk about the waterfall. How does everybody get paid and where are they positioned? So number one in the waterfall is return of all investor capital and the 10% accrued pref. Another thing that I'd like to mention is once you invest, there's a 90-day wait before you start to accrue interest, which is very common in the industry. Gives us time to move the ball along and get into the construction process. Uh, and the accrued pref, when it should, we are forecasting it to start paying in Q4 of next year and project to start a return of capital in July of 2030. Whether we sell or not, you're still going to start to get you some of your capital back. So after the investor has all their money back and their 10% of accrued pref, then next comes a 2% management fee to PPR behind all of that. And then at sale, there's a profit split with the investor, whereas the investor gets 60% and PPR gets 40%. So the first thing that people always say is, hey, wait a minute, slow down. Typical market is 80/20. What's the deal? Why would I want to do 60/40? So let's walk down that path. Typically, the investor gets 80%. There is 20% to the company, along with a 2% management fee. And that's pari passu from the beginning. So, said another way, if there's $1 in profit, 2 cents goes to the management fee, 80% or 79 cents goes to the investor, and 20% or 19 cents goes to the operator. Make sense, Matt?
Yep.
So here it's different. Here, if there's $1 profit, it goes entirely to the investor. And every dollar of profit goes to the investor until they're made whole, plus their return. So the investor has a safer position in the waterfall compared to that 80/20. And as is most things in life, with lower risk come lower profits or lower splits. And it shows that we're so comfortable that the floor is well above 10%, that we're comfortable doing that before we make a penny. So basically, we're investing in the business by managing the relationship with the sponsor, doing the surveillance. There's a saying, in God we trust, everyone else show the data. So we're following up, managing the investor relationship, the accounting, et cetera, for as long as it takes to return the investor capital in return. It keeps with our goal of protecting the investor by placing them first in the waterfall. Uh, Basically, the investor is a member interest holder in the LLC, essentially a limited partner. So since we were on a CAMA call, we obviously want to do things through the self-directed. However, if people choose to do things outside of the self-directed, there are significant depreciation advantages in the car wash industry. The government views it has much different views of car wash versus your typical business, and it's very accelerated. In fact, $150,000 investment is expected to be you're going to get between 90 and 100% depreciation. Uh, It'll be 100 if we open all three. If it bleeds down to two, then it might be 90. But last year it was 100. Now, I do want to caution people that it's not saying it's tax free. I like being upfront with people, and it's deferred. You're kicking the can down the road, but it will be recaptured at sale. But you're kicking the can down the road for 5 or 6 years, so it could be a nice little benefit. So with that, I appreciate everybody listening to my shameless plug. Are there any questions?
No questions yet. I did have a question myself about, I guess just risks in general. What would be some of the risks, either with your scaling goals or just in general to the strategy?
Would you believe me if I told you there are no risks?
I would not
You
believe it.
shouldn't. You shouldn't, because there are always risks.
Yeah.
So let's talk about what are some risks in the car wash industry. Probably one of the biggest ones, or the two biggest that I can think of, is approvals. So many companies, they have this goal of, we're going to open 7 car washes in X period of time, and the next thing you know, they're delayed by a year or two getting approvals from the townships. Well, we already have 3 up and running, so that's off the table, and we have approvals for the rest. And I would say second is ramp up time. Uh, you're expecting to ramp up over 18 to 24 months. So let's say it's 24 to 30 or even a little longer. It delays the exit, which is a little disappointing.
Got it. And the delays would just come from like kind of like normal stuff, like construction delays, operational delays, things like that.
Uh, Not really construction delays per se. That could be one of them. But I was really referring to, if your location might not be as great as you had hoped,
Got it.
and it
Okay.
just takes more time to get traction. I know one person. Another thing is, you never know what's going to happen. You might run into some bad luck. I'm going to give you an example of this. Happened to a friend of mine with his business. He had a great location. He was 3 years in, and the township changed the traffic pattern
Oh,
and wouldn't allow you to make a left turn into his place. So that's tough. And if you have one location, it could be fatal,
yep.
which is another a good thing, is that you're diversified by 7 locations. And we strategically don't want everything in one market. What happens if one market falls apart? But like, if you look at I said we opened one in San Antonio. Well, there are numerous Tommies in San Antonio. So you're also getting the benefit of the brand recognition, that you don't appear to be one store. Most consumers don't care or pay attention that they might be owned by different. They just think they're going to Tommy's. So you're getting the advantage of the brand recognition without having all your eggs in the basket of one market. We're big believers in that, which is why in the PPR fund, we're in hundreds of different markets with our mortgages.
Um, with your experience working with investors um, on the PPR fund, how did it inform, how did that experience inform how you structured the waterfall on this car wash fund, if any?
Sure. So I do want to be clear that this fund is 100% separate from the PPR fund.
Hmm.
And one of the reasons we structured it this way for years, people were saying, when are you going to share some upside? This fund is that we currently have is 9% paid current, 11% if you defer it, and all the other upside is ours. Uh, and people wanted to share some of that. And that's one reason why we structured it this way. But yet, we wanted to at least put their capital and part of the return first in the waterfall for their safety and security.
That makes sense. Um, we haven't received any questions from the audience, so I think we can go ahead and wrap things up. Let me grab the um, webinar or the PowerPoint, and I will share your contact information. And as I'm doing that, if you want to provide any closing comments for the audience.
Just wanted to remind people that I'm happy to go out to lunch with you, buy you a free meal. And I'm open to talking about either investment. I would love to talk about either investment, I should say, whether it's the car wash or if you want to take advantage of the monthly cash flow. The PPR fund starts to pay out after a 60-day investment. So you're getting, and that's a 3-year term. That's very cut and dry. The car wash, uh, it's as cash is available, so you're not certain exactly what quarter it'll start and you're getting part of your upside when it sells, so you're not 100% sure when that is. Whereas the PPR fund, 60 days after you put your money in, you're going to start to receive money regularly, and you have an exit date of 3 years. And obviously, encourage you to invest in either fund through Gamma.
Appreciate that. All right. Here is Bob's contact information in case you want to get that free lunch and ask more questions of him about PPR's investment opportunities. I appreciate everyone joining us today. Bob, I really appreciate your time. And
Thank you,
maybe
Matt.
a quick plug, actually, we're talking about having you on again at the end of the year, um, maybe the beginning of 2027. Do you want to give a
Yep.
quick teaser
What
about what that might be about?
Yeah, what I want to do is I only spent 2 minutes talking about the PPR fund. I want to explain more about each of the verticals, the non-performing loans, the multifamily, the build to rent. I want to talk about how the industry works. I want to talk about how we make money. I want to talk about the low correlation to the stock market, which is great for diversification.
Awesome. And yep, in 6 months' time, I think there should be some interesting things going on in the mortgage world. So that'll be a good check-in call with you. And if you didn't see it, I did share Bob's January presentation in the chat. So be sure to take a look at that. It's very, very educational, very informative. So please take a look at that if you can. Otherwise, we'll see you next week and everyone have a great holiday weekend. Again, thank you very much, Bob.
Thanks, everyone. Thanks, Matt. Take
Bye.
care. Stay dry out there.